Good morning, you're watching One News Now Markets. I'm Dani Laurel. Now, before we delve into the equity space, here are the top stories of the hour. The country's balance of payments swung to its largest deficit in 5 months in the month of February. Data from the Bangko Sentral show that the BOP position reversed from a $3 billion surplus in January to an $895 million deficit in February. This shortfall is the biggest in 5 months or since the $2.34 billion gap in September of 2022. The Bangko Sentral said the deficit in February reflected dollar outflows arising mainly from the government's foreign currency withdrawals from the Bangko Sentral to settle its obligations and to pay for various expenses. The BOP measures the country's transactions with the rest of the world at a given time. Now, a deficit means more funds left the Philippines than what went in. Now, IT retailer Upson International has commenced the offer period for its IPO that could raise up to 1.95 billion pesos. The company said it is planning to sell about 625 million common shares with an over-allotment option of 62.5 million shares at 2 pesos and 40 centavos apiece. Now, Upson says it plans to use the proceeds of the IPO for expansion. That's as the company seeks to open up to 50 stores in Metro Manila and key cities outside the NCR this year. The offer period began on March 21st and will end on March 27th. Equity is finally getting a breather with financial sector intervention, but have the concerns waned? Here to chat with us, we have Aaron Tsai of First Metro Securities. Good morning, Aaron. Welcome back.
Hi, good morning, Danny. Thank you for having me.
Okay, Aaron, let's kick off with the global equities story. No, we see a sea of green overnight in Wall Street, moving over to Europe, and the same seems to be happening as we open the Asian markets today. Can you say that the intervention with all these financial banking woes overseas has been swift enough to contain any more risks of a contagion?
Yes, for one, definitely the rescue, the rescue from the authorities have really been helpful, at least to shore up the sentiment of the market. But again, as we know, when there are things like this, we have learned from experience. When there are things like this, there might be more than can meet the eye, But again, in the short-term sentiment, yes, they are supported now with recent actions to bail out the banks, especially those that are bigger banks that can affect the system. But moving forward, I think swifter action should be enacted, Especially we have learned from the financial crisis that this could be just the start of something else.
Okay.
We hope not. No, we hope not. But hopefully the regulators can be on top of this once again and maybe tighten the safeguards again. At least up to the point that when the investors have the confidence again that the banks are really capitalized and really have the assets that are good for the economy.
Okay. Now, on the one hand, it's that issue of the banks being capitalized. On the other hand, it's the issue of this pointing towards a global recession or at least a recession in the US. And at the start of this year, we were thinking, okay, wala na yan. It's getting better, diba? What is your outlook right now?
I guess the main theme now really is the tightening. We have seen from the actions of the central bank that really the bias is towards a tightening cycle, and we have seen the price action, more especially for the benchmark US 10-year yield. It has really broken above the resistance of its 40-year decline. So the story that we have been used to for the past decades for the past decades. Again, as we look at the chart of the 10-year yield, it has been going down since the 1980s, and we have been accustomed and we have aligned our business models. We have aligned our even economic planners have aligned in themselves, the required rates for the projects, among others, to declining rates. And now we are being faced with the possibility of a new cycle again, and that is a cycle of higher interest rates moving forward. So, and we know that the the higher interest rate environment is not really it's not really helpful, no, or maybe at the very least can cause some dent on the fundamentals, no, both on the macroeconomy and maybe on the corporate, no, plus the valuation. So I think moving forward, the challenge would still be there. Of course, policymakers and of course corporates can have their recalibration, no, to adapt to the new trend, no, of the interest rates. But I do expect that it would be somehow be challenging at the very least moving forward.
Okay, now let's look at our rates and how you think the BSP might change course here, because we saw the inflation not really waning, at least on the last sprint, and now with these issues of the global recession, they need to be balancing what they're going to be doing tomorrow, also what the Fed is going to be doing today. What's your outlook on this, on how the BSP might change course? What are the markets pricing in?
The BSP has been fairly aggressive, no, or at the very least keeping itself at par with the global central banks, mostly in the Fed, no. But in line with that, no, I think there is also a case for somehow a pause, or maybe a minimal, no, rate hike, no, as we look first at the effect of the previous rate hikes, no. Anyway, the inflation trend has seen improvements at the very least, no, both on the US and in the Philippines, no. So if we see these factors coming down moving forward, then we might be, if the BSP or the policymakers increase policy rates as aggressive as they were in the past meetings, then they might be putting some hard stops already on the economy, which again would could hasten or maybe worsen the effect of higher rates for the economy. So I think for now, it's a good choice for the policymakers to either pause, or just to communicate that they are still on top of it and they are still maybe wanting not to be true to their mandate to really promote price stability, to just hike interest rates at the minimum, maybe 25 bips tomorrow.
Okay, but do we need to keep in step with the Fed at this point?
I'm not sure how we cannot. No, how we cannot be, maybe not maybe not exactly in step, no, but definitely we have to be at least on the watch, no, maybe at least at par, no, with the developments, no, in the US Fed, especially if the short-term rates of the Fed has a power to influence are guiding the long-term rates. So as we know, the differentials in the rates, the benchmark rates in globally in the US and in ours are really a factor to so many things, especially our currency. So if we are to somehow safeguard the volatility and the levels, of our currency, then we must be. I think we have not much choice, but to somehow keep abreast of the developments in the interest rate cycle in that part of the world.
Aaron, since you mentioned currency, one issue that might be sort of positive for the Philippines is if the oil continues to go lower. What's your outlook on the currency now with this situation of a possible recession, lower oil prices, and how that would affect the peso?
Well, two things. The recent action the recent price action that we have seen in the charts of oil has been maybe fundamentally it has been consistent with the fears of recession. But when we look at the chart of the oil, it has broken into from a long-term downtrend in several years back, and now it's just retracing that move. So we are looking at still a possibility of a lower oil prices moving forward. But after this, we do anticipate that it would continue its rise. Maybe in the next year or two.
Okay.
So that's oil. But for peso, I think the more maybe the more potent influencer, or the more potent driver for the peso is really either the benchmark rates, and of course the dollar index. So for now, at least for the short term, for now we continue to see the possibility that the peso might continue to strengthen, both as both the US 10-year and as both the US 10-year the DXY, no, the dollar index continue with their correction after surging to so much for the past several quarters already.
Okay. And finally, Aaron, given this situation in our local equities, are there some defensive sectors, defensive stocks that would perform well during a time like this, during this type of financial crisis, and might be isolated from a possible contagion?
Coming from the perspective of valuation, possibly, again, if we are talking about the possibility of higher rates moving forward, higher rates would hit the equity space both on the corporate results, no, again, especially for those who are highly leveraged companies, and also on valuation front, no, especially when fixed income alternatives become more attractive, no. But
Okay.
of course, when we talk about resiliency, as have proven during the COVID crisis, definitely the consumer sector can possibly provide that resiliency. But of course, again, even with this resilience, no, even with the proven resilience, so to speak, of the consumer companies, no, if we do the valuation and adjust it for higher WACC maybe, or higher discount rates, and we might get some hit on the valuation front. So maybe we can take position on those, no?
Okay.
And maybe a better perspective would be to take the long-term view.
Okay, and finally, do you see a support level now with this chart and the momentums? Which direction is this going, and do you see a strong support?
Yes, for the PSEI, actually, we hit support around the 6.4 area, which was the lows in December 2022. No, if it continues to bounce from here, which I think it would, since the SPX has already resumed its rally, no, after after retesting the previous resistance. If we somehow move in line, no, with SPX or S&P 500, I'm looking at the next resistance around 6.8 to 6.9 for the PSEI.
All right, thank you so much for those insights, Aaron Sayo, First Metro Securities. Thank you.
Thank you, Danny.
And those are the top business stories of the hour. I'm Danny Laurel. Join us again at 2 p.m. We are One News, all sides, all the time.